Joining us this morning, former Fed Vice Chair Richard Clarida, who's also a managing director at PIMCO. Richard, great to have you back. Thanks for joining us on such an important day for the economy and the markets. I mean, Street's trying to navigate whether or not there is some migration in the Fed commentary after, say, Goolsbee last night. Are you seeing it?
Well, a little bit. I did take note of Austin Goolsbee's comments, but also recently you had Sue Collins from Boston, who was very much leaning in a more hawkish direction. So I think it's not really a pattern so far, and we'll have some chance to get further Fed speak before the blackout, for sure.
Meantime, minutes this afternoon, where I guess you would agree the focus will be on what officials were saying about bank stress a few weeks ago, yes?
Exactly. There was some reporting recently that the meeting was a close call, so the minutes presumably will reveal how close a call it was. Obviously, that meeting occurred really in the midst of the SVB and Credit Suisse situation, so it's a little bit stale, but nonetheless, yeah, I'll be looking for that.
Do you guys at PIMCO, Richard, think that there is a severe credit tightening happening that will weigh on the economy? Because we just have not heard that really from some of the Fed officials. New York Fed president, and then this morning, Tom Barkin of the Richmond Fed. Just didn't seem like they're seeing a strong evidence of that yet.
Yeah, so a couple of things on that, Sarah. First, the Fed releases the so-called SLOOS, loan officers' data, quarterly, and that showed even well before SVB and Credit Suisse that there was some tightening in lending standards. So that was in play already. I do agree with the chair and the Fed statement a month or so ago that incrementally we'd expect some further tightening in credit conditions. Whether or not it's severe, I think it's too soon to tell. I think it moves in the direction of slowing demand, which within reason is what the Fed wants. But I would agree that right now I don't see anything flashing that it's a severe crunch.
So what do you do with the disconnect between the market and the Fed? Here we are again. Do you fade the cuts that the market is now pricing in because we're not hearing that or seeing that from Fed rhetoric, or do you believe the market?
As I look at my screen this morning, it looks like roughly a three-quarters chance, a 75% chance that they do hike in May. That seems reasonable to me. Certainly, the projections at the March meeting indicated that all but one member of the committee thought at least one more hike would be appropriate. So I do think they will get that in. And right now, I would guess they would get it in at the May meeting. But I also think they've done a lot. And certainly inflation expectations appear to be anchored. So I think we are close to an extended pause here. Pricing in rate cuts, they're certainly pushing back against that. We saw the chair push back against that pretty specifically in the March press conference. And if cuts do happen, I think they'll happen in the context of inflation coming down more quickly than the Fed expects. But right now, as you had Tom Barkin on, and I saw that segment, there is some good news on inflation. I think we have seen peak inflation, but it's still running somewhere in the fours, which is well above the Fed's ultimate goal. So I think they have that in mind as well, and I think that argues against some cuts in the near term.